All right, let's get right into it. Today, we're tearing down the upcoming Hong Kong IPO for the semiconductor company Novosense. There's a lot of buzz around this one, so we're going to dig into the numbers and see if it's actually worth your money. You know, you see quotes like this and you might roll your eyes, but honestly, this is the best way to think about what Novosense actually does. Imagine all of the electric cars, the automated factories, all that smart tech. They all need to sense what's happening around them. Novosense makes the chips that are literally the nerves. They feel temperature, speed, magnetism, and then tell the machine's brain what's going on. It's a really cool and critical piece of the puzzle. And that's the big question, isn't it? The story is awesome. I mean, who doesn't want to invest in the nervous system for the future? It's a fantastic narrative. But, and this is a big but, does the investment actually make sense when you look at the cold, hard numbers? That's what we're here to figure out. So let's start with the business itself. What are these so-called nerves and senses? And, more importantly, how do they make money from them? Is this a business with a real defensible edge? Okay, so let's rewind to 2022. Back then, the business was pretty simple to understand. It was all about their signal chain chips. We're talking over 60% of their revenue. These are basically the interpreters in the nervous system. They take a signal from the real world, like heat, and translate it into digital information a computer can use. This was their bread and butter, no question. But now, fast forward to just a couple of years later, and look at this. The whole picture has changed. Signal chain is way less dominant. And the big story? Look at sensors. They went from almost nothing to over 27% of the business. That massive jump didn't just happen on its own. It's all because of a huge acquisition that is frankly at the very heart of this entire IPO story. So what stops a bunch of competitors from just jumping in and doing the same thing? Well, this is their secret weapon, automotive-grade certification. This is not just some piece of paper. We're talking about a brutal 2 or 3 year process to prove your chip won't fail inside a car. Because if it does, well, that's a disaster. This created a huge wall that keeps a lot of would-be competitors out. And that certification is what creates their moat. Think about it. Once a car company like BYD puts your chip into their new EV platform, they are not going to switch it out. It's too risky and too expensive. So for the entire life of that car model, Novosense has a locked-in customer. That's what we call sticky, predictable revenue. It's a fantastic business model. So the story is good. The business model seems solid. They've got a moat. Sounds great, right? But does the financial reality actually match up with that story? Okay. Time to pop the hood and see what's really going on with the engine. And yikes, this is where the story takes a really sharp and painful turn. In 2022, things were great, a nice 250 million RMB profit, but just 2 years later, that has completely flipped into a massive loss of 403 million. What happened? In a word, a price war. A really, really nasty one, started by the big global players like Texas Instruments. You can see the damage right here. Look at those margins. They went from a super healthy 48.5% all the way down to just 28%. When the giants of the industry start slashing prices, a smaller player like Novosense has to follow, or they lose all their customers. All that profit they used to make on each chip? Pretty much gone. And if that wasn't bad enough, there was the inventory problem. At one point, it was taking them 294 days to sell their chips. In the semiconductor world, that is an eternity. It's a ticking time bomb because those chips can become worthless really fast. And in fact, they already had to write off over 91 million RMB of inventory just this year because of it. Okay, so a price war and an inventory nightmare are obviously huge headwinds. But as you dig deeper, you start to find some even bigger, more structural problems. I'd almost call them fatal flaws that any investor absolutely has to know about. Let's go back to that big acquisition, the one that made their sensor revenue look so good. They paid about 1 billion RMB for a company called Magnatech, and while it goosed their sales numbers, it came with a huge price tag. Specifically, it put over 500 million RMB of something called goodwill onto their books. What that really means is they've made a massive $500 million bet that Magnatech is going to be a superstar performer in the future. So what on earth is goodwill? Well, in simple terms, it's the extra money you pay for a company on top of what its physical assets are actually worth. You're paying for its reputation, its potential, and for you, as an investor, this is a landmine waiting to go off. If Magtech doesn't deliver the profits they're hoping for, they'll be forced to write off that goodwill, and that will absolutely crush their future earnings reports. And it doesn't stop there. There are two other huge risks. First, nearly 80% of their sales go through middlemen, not directly to the car companies. This is risky because those middlemen could just be stockpiling chips, creating a false sense of demand. It's called channel stuffing. Second, they are incredibly reliant on just 5 suppliers for almost 90% of their parts. If their main supplier has a problem, Novosense basically gets shut down. That is a massive bottleneck risk. Okay, let's pull this all together. We've got the great story about being the nervous system for machines with a real competitive moat. But we've also uncovered some really serious financial problems and operational risks hiding just below the surface. So, what's the final verdict? What's the strategy here? So here it is, side by side. On the plus side, you've got a great position in the auto industry. That high barrier moat from certification, impressive sales growth from that acquisition, and some big name investors backing the deal. But the list of cons is pretty scary. Profits have collapsed, they have a mountain of inventory, there's that huge goodwill risk on the balance sheet, and they're way too dependent on their distributors and suppliers. And let's just quickly touch on that last pro. What's a cornerstone investor? Basically, it's a big, well-respected institution that promises to buy a bunch of shares in the IPO and hold them for a while. It's seen as a stamp of approval for sure, but you have to weigh that against all the fundamental problems we just talked about. So, putting everything on the scale, the final rating for this IPO comes out to 3 stars. It's basically neutral, maybe even a little bit negative. It just perfectly captures that conflict between a great story and some really worrying financials. And that leads to a very clear, very simple conclusion. Based on all this analysis, the final call is to skip the Novosense IPO. The risks right now just seem to outweigh the potential rewards. The story is good, but the timing is bad. But a good strategy isn't just about saying no. It's about finding where to say yes. So, if we're passing on a big, flashy IPO like Novosense, where are the better opportunities in the market right now? Well, the analysis points to 2 other IPOs that are happening at the same time, Xiao Noodles and Able Digital. Now, these are much smaller deals, and in a shaky market like this one, smaller can actually be much better. They don't need as much money to get going, and with fewer shares available, you can sometimes see better performance right out of the gate. They're just more nimble than a giant, complex deal like Novosense. So here is the final, actionable game plan. Instead of getting involved in the big, risky Novosense deal, the recommendation is to pivot. Take the money you would have used there and actively participate in both of the smaller IPOs. Split your application about 50-50 between them. It's a strategic move away from a flawed, high-profile name toward a couple of smaller, more manageable opportunities.